Good morning. Silver markets opened the week under significant pressure on Monday, February 23, 2026, as the precious metal registered a price of $87 per ounce at the New York Cash Open. The figure sent notable turbulence through financial markets, drawing attention from traders and analysts tracking conditions across both Western and Eastern exchanges. According to market observers, Monday's opening price was not driven by a single factor, but rather by the convergence of three distinct developments: escalating geopolitical tensions in the Middle East, a domestic legal ruling in the United States carrying substantial fiscal consequences, and a persistent physical supply deficit in the silver market. Together, these developments created conditions that analysts described as exceptional for the metals market at the start of the trading week. Adding to the significance of Monday's session was the scheduled reopening of Chinese markets later that evening, with both the Shanghai Gold Exchange and the Shanghai Futures Exchange set to resume trading at approximately 8 o'clock Eastern Standard Time, following a full week of closure due to the Lunar New Year holiday. Beginning with the international dimension, United States military forces were reported to be conducting a significant buildup of naval and air assets in the Middle East as of Monday morning. The deployment included carrier strike groups, strategic bombers, and amphibious assault ships moving into position across the region. Simultaneously, President Trump had issued a publicly stated ultimatum directed at Iran, described as carrying a narrow and specific window for response. The geographic focus of concern centered on the Strait of Hormuz, a narrow waterway through which approximately 20% of total global petroleum consumption passes each day, translating to roughly 21 million barrels of oil in daily transit. Analysts noted that any disruption to that waterway could produce crude oil price increases of $30 to $40 per barrel overnight, with cascading effects on global inflation expectations. Silver was identified as serving a dual function in this environment, both as a safe haven asset during periods of geopolitical instability and as a hedge against inflation linked to war financing and monetary expansion. The second major development weighing on markets was a domestic legal ruling issued by the United States Supreme Court prior to the weekend. The decision, referred to as the SCOTUS 63 ruling, dismantled the executive branch's authority to use the International Emergency Economic Powers Act to impose peacetime tariffs, creating a refund liability for the United States Treasury estimated at $175 billion. In response, the administration issued a new 10% global levy under a separate temporary 150-day legal authority. Market observers noted that this sequence of events created an environment of significant uncertainty for global trade participants, and that the BRICS coalition of nations was likely to interpret domestic legal instability of this nature as an accelerant for de-dollarization efforts, pushing capital away from dollar-denominated assets and toward hard assets such as silver and gold. Turning to physical market conditions, prior to the Lunar New Year closure, silver trading in Shanghai had already been occurring at a premium of $3 to $5 per ounce above Western spot prices. The persistence of that premium was interpreted as evidence of a structural disruption in the global silver supply chain. Furthermore, effective January 1, 2026, the Chinese government reclassified silver from an ordinary industrial metal to a strategic material, restricting its export. Given that China controls approximately 60% of global refined silver processing and export, that policy decision effectively removed a substantial portion of available supply from Western markets. The reopening of Chinese exchanges on Monday evening was therefore expected to release significant pent-up demand from industrial consumers, including solar panel and electronics manufacturers, who had been unable to secure inventory for an entire week. Within the COMEX futures market, February 27th was identified as the first notice day for the March silver contract. As of Monday morning, March open interest stood at 429 million ounces, against registered vault inventory of just 103 million ounces, a coverage ratio of less than 25%. January 2026. Delivery data showed 49.4 million ounces physically withdrawn from the exchange, representing a 400% increase over the historical average, with sovereign wealth funds, Eastern central banks, and industrial conglomerates identified as the primary participants. If 25% of March open interest were to stand for delivery, registered inventory would be fully depleted, potentially forcing the exchange to pursue cash settlement or declare force majeure. Also noted was the historical use of margin hikes by the CME group during volatile periods, a mechanism that increases capital requirements for futures holders, triggering forced liquidations and sharp paper price declines, as seen during silver volatility in 2011 and the early 2020s. As the session developed, market participants were advised to monitor the $85 support level, the United States dollar index, end-of-day open interest figures, and most critically, the Shanghai premium at the 8 o'clock Eastern reopening. A widening of that premium to $8 or $10 above the COMEX price would signal concentrated Eastern physical demand, placing direct pressure on Western silver reserves. Each factor present on Monday, military positioning, fiscal legal disruption, Chinese supply restrictions, and COMEX inventory exposure, was independent in origin, but convergent in effect, all applying simultaneous pressure to silver markets as the trading week began. Market participants were urged to consult primary source data directly, including CME Group warehouse inventory reports and Shanghai Gold Exchange premium data, to independently assess conditions as the week progressed. That concludes our coverage of Monday morning's silver market conditions. We will continue to monitor developments across both the New York and Shanghai sessions throughout the trading week. Stay with us for further updates as this story develops.